Good morning.
So give us your thinking, because you're saying where AI goes is where the global economy goes.
Absolutely. 2019 is going to be the year of the transition between the old economy and the new global economy. This has been happening for the last 15 years, and the real race is who's going to dominate AI, automation, and the future economy.
So how should I look at this trade deal, essentially, that it seems like we're inking to some kind of deal here at the moment? Is it the fact that we are at least reached some type of conclusion, the uncertainty is erased, therefore markets are continuing to rally? Or, I mean, how should I be interpreting these lines? Like,
Sure.
Is it all priced in, is that, I guess, the question?
That's a good way of explaining it.
Yeah.
It is priced in at the moment. The reality is it won't be over until Trump has faced the 2020 elections next year. So the reality from a political point of view is this trade war is definitely not over. But from a markets point of view, what's been driving us since March of 2016 is the momentum trade. And that's still in force.
Didn't work yesterday, last year.
No, but what was good about last year is we saw 10-year yields go above 3%, the 3.00, very dangerous level, which has triggered the last 3 US recessions in modern history. It came back from 3.26 to about, at the moment, 2.75. That's a sign that there is still some steam left in this engine. That's a positive. Whether that continues through 2019 is obviously the million-dollar question.
You were talking about the US in a bit, but I want to keep it on China at the moment. You know, the NPC, I can't remember who said it, said they're going to come up with their growth target, and this individual said, well, this is the only country in the world which tells everybody what they're going to be growing at, yes. And they managed to do it by the end of the year, yes. And they do that in March.
Rabobank came out with a very scary statistic that 5% of social private funding in China was consumed in January alone. So that is really what's prompting or propping up the Chinese growth story at the moment. Whether that is sustainable is a concern for investors. As you mentioned in the last section, there is still some buoyancy in Chinese mainland stocks. But again, the real question is where this is heading from a political point of view, but particularly from a markets point of view for the US and also China.
So you're not chasing this rally?
No, absolutely not.
Okay.
Have you missed out? Sorry.
Yeah, no, that's
no.
the question, I guess.
No, I guess if you zoom back out, we're still in the same momentum trade that started from March 2016. And if you believe there's still legs left in this cycle, which would suggest we still have another 12 or 18 months, yes, you would stay in mainland equities, and same with S&P 500. If you don't, then you need to look at alternatives.